Within the volatility of the financial system, we see China's stock market increasing regulations and restrictions in order to prevent a collapse. You came here for the truth, so let me unveil that for you. Today we are going to get into China for the most part. I want to show you this. We're looking at an article out of Bloomberg, and it says that China seeks more control over algorithmic trades blamed for the rout. That's right. Another finger pointing, but this time at some computer algorithms. I've told you before that the computer algorithms control the markets. I'm going to prove it to you today, and we can look at this here. Chinese regulators are planning to increase their oversight of algorithmic traders, extending a campaign to stabilize the equity market that some analysts say has resulted in shrinking volumes and an exodus by foreign investors. People are scared whenever there's a crisis or whenever there is some volatility. They're going to be shaken out, and that's just the way it's been going for quite some time now. Under the draft rules released by China's securities regulator, traders who use automated orders to buy and sell stocks will need to report certain information and wait for a review before they're allowed to execute their strategies. So they're trying to slow down the whole computer algorithms, and that really defeats the purpose of them. The whole intention of this is to have them be traded in and out in seconds. Now, I think this is the worst idea ever, having this ability, but this is the way that it goes. The paper markets are in fact controlled by these algorithms. Orders shouldn't originate from offshore computers or domestic systems that are remotely controlled from overseas. So they're trying to have the foreign investment brought down to a minimum. In this case, it's just a little too hectic right there, and they're trying to calm things down for the time being. There's much more in this, but I'd like to move on for a second here. If you look at this article out of the China Morning Post here. Once star performance in China's summer stock woes, homegrown hedge funds are poised to undergo an industry-wide shakeup with small players out and heavyweights left to survive as their key source of revenue was cut off after Beijing's market rescue measures. So what they're saying here is that typically you'd have the hedge funds doing well. However, because of recent regulations, things aren't going so well. We thought a bear market would help us stand out, and actually we did. But things were turned upside down by the new regulations on stock index futures trading. This is a money manager saying this. And we have the situation that has been taking place here in China where they had some volatility and the government stepped in with a few measures. A lot of them actually increased the volatility, which was truly unfortunate, but this is how the government always reacts. And it doesn't matter if it's China or the US or what have you. You always have what they did in this case was basically reduce the amount that banks need to keep in their vaults, and they also basically loosened up on the lending practices, so you can give out money to people who shouldn't have it in the first place. Hedge funds typically navigate an equity meltdown better, with Greater China hedge funds outperforming the underlying markets over the sustained meltdown this year. But it doesn't matter because they're all being taken down. It's just one is first and then the other one comes after. It doesn't really matter. From my book, I just wanted to show you this just to illustrate a point. Housing in the US and other countries has collapsed after a major boom, leaving millions of empty homes waiting to be purchased. Now, this is the stupidity of their decisions. They're going to build millions, literally millions of homes, leaving them empty in hopes that investors like those in China will buy them up. But what happened? You still have subdivisions, full subdivisions empty. Why? Because they overreacted. That's the way it always goes. That they have to build millions of homes extra. It just goes to show you that they never make the right decisions. Now here it is out of Bloomberg, their own words. By 2010, HFT, high frequency trading, accounted for more than 60% of all US equity volume and seemed positioned to swallow the rest. You're looking at more than half of all trades being conducted by a computer automatically. Now, what do you think is going to happen if that's the case? Well, obviously, they're going to overreact, just like the governments overreact. And look what happened. We had the flash crash back in 2010 that caused a massive collapse in the prices. And this is going to happen again. In fact, I've covered it here, but you can see oftentimes if you look at the daily analysis for stocks, where they are manipulating is very clear. You have millions of trades that occur in only a fraction of seconds, where an individual human being could never do that. They're fast. Human traders can be very fast, but they can't be as fast as these computer algorithms. And it's very scary, and that's why China is trying to at least restrict it in a bit, but it's just getting to be such a big business that I don't see it really taking off. Funding for tech startups appears to be going strong, but there's a looming concern that it could be too strong enough that it's already fueled the next tech bubble. This is out of CNBC, and of course, it is a bubble. The whole stock market isn't a bubble, but the real bubble is the central bank's QE. But a topic for another day. Some investors and analysts have been reluctant to say outright that we are in the midst of an overgrowth in tech. Of course, there's never a bubble, though. If you actually check the mainstream media, the financial media, you will find that they will never claim, even like 10 years down the road, they're not going to even claim that there's a bubble. 15 years ago, the sector was relatively young, but now with established companies like Apple, Microsoft, and Facebook leading the charge and better tech representation among the S&P 500, the industry has matured. That's right, nothing to worry about here. There's always something to be concerned about with these paper markets because of what they do, always chasing corporate profits. When the economy is going down, they're chasing corporate profits. When it's going sideways, they're chasing corporate profits, and the same when it's increasing as well. They're always trying to make more money. And for good reason, all businesses want to make profit, but they do so at the expense of the individual. That's what bothers me most. Out of CNBC again, Apple has done better than the broader market this year, rising 1.5%, while the S&P has fallen more than 2%. However, the stock is still on track to log its worst performance in 6 years. So here we are, everybody relying on Apple to do well, and yet it's having its worst year out of the last 6. You're not going to have good years for any of these stocks as long as the central banks don't print money. It's the way it works. If you print money, stocks or any other asset could go up. If you don't print money, well then nature's going to take its course, and of course that means downward. And then we have this article, we just wanted to tie it in. A new study tracking teens and young adults finds that stealing is quite common. About 1 in 6 report have swiped something in the past year. There's many reasons for this, but I just wanted to mention this, first of all, to show you that the economy is going down. Where you have prosperity, you have less crime and activity. That's a fact. You can look that up in any country. Where you have more prosperity, there is less crime. It's generally the way it goes, and there are facts to support that. But I can't help but feel that in many ways, we're being stolen from as well. The average individual. They use inflation to steal from us every single day. They use fraudulent taxation to steal from us when we purchase a product or perhaps when we pay our taxes. They're always taking from us, and it doesn't seem to be stopping anytime soon. The so-called temporary taxes are always stretched and even increased as time goes on. All they continuously do, and by the way, this they is the government, but the bankers all as one. Their intention is to siphon as much wealth as they can from the middle class, evaporate the so-called rich class, and have a small set of the elite and everyone else. And they're doing so very, very well. The public doesn't see that. Even those who consider themselves to be informed aren't really paying attention to the right information either. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you'll find my book, The Money GPS, even more informative. If you want to go ahead and look at it, just head over to Amazon. They have this look inside feature. You can flip through the pages of the book and see if you like it. Take care.